Much as I would like to print my own money and get high on my own supply, sadly, I'm not able to do that, and I don't think it's right that the state can do it in my name.
Why can't we just print more money? During the COVID pandemic, the government injected a staggering £450 billion into the British economy through a process called quantitative easing. This extraordinary monetary stimulus has been linked to surging inflation and, indirectly, rising mortgage costs. As a result of the economic upheaval that it triggered, quantitative easing is back in the spotlight.
We got the 10-minute rule bill, and that gives me 10 minutes uninterrupted in the chamber. And one of the things that I have a bee in my bonnet about is quantitative easing. Given the historical track record of states abusing their citizens by various forms of currency debasement, including QE, the default position should be to make it illegal unless this democratically elected House has an informed vote supporting debasement. This bill seeks to achieve this position, and I commend it to the House.
That was Great Yarmouth MP Rupert Lowe, explaining why he wants to introduce a bill that would allow Parliament to override the Bank of England and block future QE measures. But before we unpack this powerful monetary tool, it's worth delving into the history of money and tracing the decisions that got us here in the first place. Here's a question. Why do coins have milled edges? In medieval Europe, when coins were made of gold and silver, people used to clip their coins. They would cut off slithers from around the edge and extract the valuable metal to melt down into bullion or new coinage. Medieval governments didn't take well to this currency debasement. In fact, in the 15th century, the English government made the practice a capital offence. However, the introduction of milled edges by Isaac Newton in the 1690s, alongside other measures such as standardising the purity and weight of coins, eventually caused the problem to subside. Today, governments around the world actively participate in a type of currency devaluation not dissimilar from coin clipping. It's called quantitative easing. After the devastation of the Second World War, the Bretton Woods Agreement was established, with the goal of creating monetary stability and providing a solid foundation for Europe's recovery. Under this system, all national currencies were pegged to the US dollar, which itself was backed by gold at a fixed rate of $35 per ounce. This structure aimed to ensure stability in international trade and foster trust in the global financial system by anchoring currencies to a tangible asset, namely gold. For many years, the system functioned relatively smoothly, with the US holding the largest share of the world's gold reserves, positioning the dollar as the dominant global currency. However, as the United States began running large trade deficits, partly due to military expenditures during the Vietnam War, its gold reserves started to deplete rapidly. This imbalance, combined with inflationary pressures, led to a situation where the US could no longer maintain the dollar's convertibility to gold. In 1971, facing mounting pressure and a growing financial crisis, President Richard Nixon announced an end to the dollar's convertibility into gold. This marked the collapse of the Bretton Woods system, effectively ending the gold standard. With this shift, modern fiat currencies, money not backed by any physical asset, emerged. The move to fiat currencies marked a fundamental change in the global financial system. Unlike the previous system, where money was tied to tangible commodities like gold, fiat currencies rely entirely on trust in the governments that issue them. This shift provided governments with greater flexibility in managing their economies, but also introduced new risks. The value of fiat money became increasingly dependent on political and economic stability, rather than being anchored to physical reserves. If trust in government is undermined or mismanaged, the currency's value can plummet, resulting in inflation and economic instability. This is precisely what happened in Japan in the early 1990s. The burst of Japan's bubble economy in 1991, created by artificially low interest rates and excessive money supply expansion, led to what became known as the lost decade. Despite ultra-low interest rates and massive fiscal stimulus, Japan's economy was trapped in deflation and stagnant growth. In an effort to combat this persistent downturn, the Bank of Japan launched the world's first episode of quantitative easing in 2001. The goal of QE was to inject liquidity into the economy, stimulate spending, and encourage growth. However, despite these efforts, Japan's economy remained sluggish, and deflation continued to be a persistent issue. So what exactly is quantitative easing? In simple terms, QE involves a central bank digitally creating new money, which it then often uses to buy government bonds. This action boosts the price of bonds, lowers their yield, and consequently reduces interest rates throughout the economy. Lower interest rates make borrowing cheaper, encouraging businesses and individuals to take out loans, invest, and spend. The aim is to stimulate economic activity and counter deflation. However, while QE increases the money supply, it does not create new wealth. Instead, more money is circulating in an economy with the same amount of goods and services, which can lead to inflation.
Whether it was kings, whether it's governments, they I'm afraid, have a sad track record of fraudulently undermining and debasing their currencies. So for me, not only the historical coin clipping, coin sweating, all the sort of things that have been done in the past, the modern day equivalent is quantitative easing.
We're all familiar with the Weimar Republic and the hyperinflation triggered by its government's decision to print money. Quantitative easing is the 21st century equivalent of this. Whether it's the Weimar Republic printing banknotes in factories or the Bank of England generating billions of pounds digitally, this long-tested monetary tool has consistently led to more harmful economic consequences than benefits. In a recession, when demand is low and businesses are hesitant to invest, QE may seem like an attractive option. It offers a way to inject money into the economy when traditional tools, like lowering interest rates, have already been exhausted. But the issue with QE is that it can create a false sense of recovery by inflating asset prices and reducing the value of money. While it may encourage short-term spending, it doesn't address the underlying structural issues within the economy. Similarly, it's important to recognise that QE disproportionately benefits those closest to the monetary centre of the economy. The 18th century Irish-French economist Richard Cantillon identified what is known as the Cantillon effect. When new money is created, it is first injected into certain areas of the economy, diverting resources towards those who receive it first. In Cantillon's time, it was those near the French royal court who had access to the new money. Today, it is typically large corporations and financial market speculators. These early recipients can purchase assets and goods before prices rise, meaning QE not only results in a transfer of wealth to those at the top of the economy, but also pulls resources away from other areas that might use them more efficiently. When the global financial crisis struck in 2007 to 2009, the Bank of England, alongside other central banks worldwide, adopted QE in an effort to revive their economies. In the UK, the Bank of England launched QE in March 2009, initially purchasing £165 billion in bonds, followed by an additional £175 billion in October of the same year. The objective was to stimulate economic growth, but the long-term consequences of this money printing were far-reaching. While QE seemed to provide short-term relief, it ultimately contributed to rising inflation, reversing the stability that had been maintained for years before the crisis. Further rounds of QE during the COVID-19 pandemic pushed inflation to 11.2% by October 2022. While factors such as the reduction in oil supplies due to Russia's invasion of Ukraine also played a significant role in rising energy prices, it is widely acknowledged that money printing was a major contributor, an assessment shared by former Bank of England Governor Mervyn King. The problem with QE is that it fails to address the root causes of economic downturns. Instead of increasing the production of goods and services, it simply expands the money supply, leading to inflation. This devalues money, eroding consumers' purchasing power. As inflation rises, savings lose value, making it harder for people to plan for the future and discouraging investment. Additionally, as the cost of living increases, real wage growth stagnates, hitting the poorest hardest.
In the people's name, the government is able to run up huge debts, which in the short term aren't necessarily felt. So rather like a frog being boiled slowly from cold, people don't necessarily feel it immediately, but over time, the value of people's savings, the value of the hard work they've put in during their own lives is being debased.
The reality is that QE, both in Japan and the UK, has failed to produce sustained economic growth. In Japan, after QE was introduced in 2001, the economy remained sluggish, hindered by an ageing population, low productivity, and the long-term effects of previous monetary policy. Similarly, in the UK, QE following the 2008 crash and during the COVID-19 pandemic contributed to rising inflation and long-term economic weakness, in turn leading to higher interest rates, rising mortgage costs, and a weakened currency. There is a serious flaw in the assumption that central banks can precisely control the economy with QE. The effects of QE are delayed and uncertain, and even the most skilled economists can't predict how much QE is needed to achieve the desired results. More often than not, central banks end up overshooting their targets, leading to inflation running higher than expected. Inflation, of course, is a hidden tax. It dilutes the value of savings, causing currencies to depreciate, and creates uncertainty in markets. For consumers, it means higher prices and lower purchasing power. For businesses, it means higher costs, less predictability of wholesale prices, and lower profitability. And for governments, it means indexed pension pots, wages, and running costs spiral, tightening the noose of public sector debt. But perhaps the most concerning aspect of QE is how it disproportionately benefits the wealthy. Not only, as the Cantillon effect shows, do those close to the monetary centre benefit first from QE, but with more money in the economy, asset prices rise, and those who own stocks, bonds, or property see their wealth increase. However, for those without significant assets, QE simply raises the cost of living, without increasing wages or improving opportunities. This exacerbates inequality and makes it harder for people to get ahead meritocratically. During the COVID pandemic, central banks around the world printed huge amounts of money to stave off an economic collapse. The Bank of England alone printed £450 billion during this period. The consequences were predictable. By 2022, inflation had surged and the cost of living had skyrocketed. The truth is, QE doesn't solve economic problems, it just delays them. It is the modern equivalent of the Weimar Republic's money printing factories. By artificially inflating the economy, it creates bigger issues down the line, such as inflation, wealth inequality, and economic instability. To make matters worse, we've started to see governments continue to pursue QE even after a crisis event, further destabilising the economy. Former Treasury Secretary Nick Macpherson even compared QE to heroin, saying that the economy gets addicted to it and needs bigger fixes for it to have an impact.
The power has been devolved to unelected people who now, I think, are unaccountable to Parliament in a way which is unacceptable. And nothing demonstrates that more than quantitative easing, which is effectively the creation of money from nothing. And what it does is it debases the money in circulation by basically, quite simply, creating more liquidity out of thin air. So it's not backed by any economic enterprise, it's not backed by any long-term investment, it's not backed by anything other than pure paper transaction to cover a government deficit.
With politicians around the world grappling with the fallout from our excessive COVID-era spending, the reality is sinking in. QE isn't just distortionary, it's damaging the economy and society at large. As governments around the world continue to undermine the value of their currencies, it's no wonder that decentralised currencies like Bitcoin and Ethereum are gaining traction. These digital currencies cannot be manipulated by central banks and offer a real alternative to the flawed policies of money printing. In a world where trust in government-controlled currencies is declining, people are looking for safer, more reliable options to protect their wealth and their future. Quantitative easing may offer temporary relief, but it creates long-term harm. By inflating the money supply without boosting real economic output, it fuels inflation, erodes savings, and worsens inequality. While the wealthy benefit from rising asset prices, the rest of society faces higher costs and stagnant wages. In the UK, QE has contributed to rising inflation and economic instability. As Parliament debates a new bill to limit its use, the reality is clear. Quantitative easing isn't a solution. It's a dangerous shortcut that only deepens the problems it's meant to fix. It turns out we can't just print money after all.